Welcome back, everybody, for another deep dive. We love to take these deep dives, and today we're taking a deep dive into The Intelligent Investor by Benjamin Graham.
A classic.
Yeah, we got a really fascinating set of excerpts from you for this one. And it's interesting, it's such a classic for a reason.
Absolutely.
We really want to kind of go beyond just summarizing it and you really try to pull out, what's the core wisdom here?
Right.
And how does it apply today? Because obviously, this was written a while ago and the market's changed a lot. But there's a lot of really durable knowledge here
Absolutely.
about investing. So
Yeah.
our mission in this deep dive is to understand Graham's philosophy, how it applies today, and what you should take away from it for your own investment decisions. And we're going to uncover things like, how to think about risk between investing and speculating,
Yeah.
and why buying stocks isn't like buying pizza.
That's an interesting analogy. I like that.
Yeah, you'll see. I mean, it'll make sense soon. But maybe you could start us off before we even get into talking about specific strategies.
Sure.
Graham really challenges us to think about what it means to be an intelligent investor.
Absolutely. And I think people often get this wrong. When
Yeah.
they first hear the title of the book, they think, oh, this is, some, like really high IQ kind of person. But that's actually not what he means at all.
Okay, so what does he mean by that then?
So his definition might surprise you. It's not about raw IQ or complex, calculations. It's much more about temperament.
Right.
So he highlights these qualities like patience, discipline, a thirst for knowledge, and emotional control.
So you're saying it's not about being the smartest person in the room.
Yeah.
It's about being the most level-headed.
Exactly. He actually says in the book that this kind of intelligence is a trait more of the character than of the brain.
Oh, I like that.
Yeah.
That's a good quote.
Yeah, so it's about how you react to the market swings rather than trying to, time them perfectly.
Well, that makes a lot of sense because, I've definitely made some bad investment decisions in the past based purely on emotion. Like that time I sold during a market dip. And then, of course,
Yeah, we've all been there.
missed out on the rebound when things bounce back.
That's so common. And Graham really understood that, fear and greed
Right.
are really powerful forces.
Yeah.
And he says, they can really be our worst enemy when it comes to investing.
Yeah.
So he has a whole chapter in the book that's dedicated to the psychology of investing.
Oh, wow.
Yeah. He really stresses that we need to understand our own tendencies.
Oh, that's so interesting.
Yeah.
And he talks about things like, the dangers of IPOs and how people just get so excited. They want to jump in right away.
Yeah, there's this fear of missing out. And
Yeah.
he says,
Right.
let the company prove itself a little bit.
Yeah. Let the dust settle, see how things shake out.
Exactly. And look for that track record
Right.
before you jump in.
Yeah. So instead of chasing the next hot stock dip, we should really be, cultivating that patience and that discipline.
Absolutely. That's the foundation
Yeah.
of intelligent investing.
Okay. So once we've, kind of gotten our emotions under control, then we can start thinking about, okay, how do we actually apply Graham's principles
Right.
to our investment decisions?
So one of the key concepts that Graham talks about is the difference between investing
Okay.
and speculating. And to him, this is paramount.
So how does he define each of those, and why is that distinction so important for investors to grasp?
So investing for Graham is rooted in this idea of thorough analysis.
Okay.
So you're really trying to understand the underlying value of a business, and then you're buying it at a price that makes sense.
Okay.
It gives you a margin of safety. Speculation, on the other hand, is much more about trying to predict those short-term market movements.
So it's kind of like trying to time the market.
Exactly. And, riding those waves of market sentiment, hoping to make a quick profit.
Yeah. So speculation is more like gambling.
That's a great way to put it. Yeah. And Graham believed that in the long run,
Yeah.
speculation is a losing game,
Okay.
especially for the average investor.
Interesting.
Yeah. He has this famous quote. He says that people who invest make money for themselves. People who speculate make money for their brokers.
Oh, that's interesting. So he's saying, Wall Street actually benefits from us speculating and trying to time the market.
Exactly. And, when you think about how Wall Street's structured, they make money whether we win or lose.
Right. Whether we buy or sell.
Yeah.
It doesn't matter to them. They're getting their commission.
Exactly. And Graham was very aware of that. And he knew that Wall Street often preys on our desire for quick riches.
Right.
They use all this hype and all these tricks
Yeah.
to encourage us to speculate.
Yeah, like we were saying with the IPOs.
Exactly. And he even talked about, stock splits and how people think that somehow creates value.
Right. Like just because you're slicing the pie into more pieces
Right.
doesn't mean the pie is bigger.
Exactly.
So how can we as intelligent investors kind of avoid getting sucked into that hype
Right.
and really stay focused on the fundamentals?
Yeah. So that's where one of Graham's most important concepts comes into play.
Okay.
And that's the margin of safety.
Okay, I've heard that term before.
Yeah.
But honestly, I'm not sure I fully understand it. Can you break it down for me like I'm 5?
Sure. So imagine you're buying a dollar bill
Yeah.
for 50 cents.
Okay, I like that.
You're essentially buying something for less than it's worth.
Yeah.
So that gives you this cushion
Right.
if your initial assessment is off or if things don't go as planned.
But even if you're wrong, you're not as wrong.
Exactly. You've got this built-in buffer.
Yeah, that's smart.
Yeah.
But how do we figure out what that right margin of safety is?
So this is where the hard work comes in.
Okay.
Because Graham was a huge advocate for thorough research and analysis, especially when it comes to understanding a company's intrinsic value.
So not just looking at the sticker price that the market's giving us right now, but actually digging deeper.
Exactly, because market prices can be influenced by all sorts of things. Irrational exuberance or an undue pessimism.
Yeah.
It doesn't always reflect the true worth of a business.
So we have to kind of do our own homework.
Absolutely.
Look at their financial statements, their management team, all of that.
Exactly. Look at their balance sheet. Look at their income statement. Really get a sense of...
See how much money they're making.
Yeah, exactly. How much debt they have.
So did he have any real-world examples in the book about companies that succeeded or failed based on the underlying value, not just the hype?
Absolutely. So one of the examples he gives is Northern Pacific Railway in the 1940s.
Okay.
And this is a case where, the market was overlooking the company's true earning power. And it was selling for far less than it was actually worth.
So even back then, intelligent investors were finding those diamonds in the rough by kind of ignoring the hype and really looking at the fundamentals. Now, what about those of us who don't have, a ton of time or expertise to analyze those complex financial statements?
Yeah, that's a great question.
Does Graham offer any guidance for, the everyday investor?
He does. So Graham outlines 2 main approaches to investing.
Okay.
And he recognizes that not everyone has the same level of, time, interest, or expertise. So he calls them the defensive investor and the enterprising investor.
Okay. So tell me about this.
So the defensive investor, kind of as the name suggests, takes a more passive approach.
Okay.
So they're prioritizing simplicity, diversification, sticking to high-quality bonds, and a limited selection of stocks.
So that's kind of like the set it and forget it approach.
For example.
You're not constantly monitoring the market.
Right. It's about steady growth over time.
And not having to spend all your time analyzing financial statements.
Exactly.
Okay, and what about the enterprising investor? What do they do?
So the enterprising investor is more hands-on. They're really out there looking for, undervalued opportunities.
Okay.
And they're willing to look across a wider range of asset classes.
So not just stocks and bonds. They're looking at maybe real estate or, more niche investments.
Yeah, exactly. They might be looking at, distressed debt or commodities or, things that require a little bit more.
Yeah, a little more specialized knowledge.
Exactly.
So for the enterprising investor, does that mean they need to have a deeper understanding of, financial analysis?
Yeah, absolutely. They're going to be spending a lot more time doing research, really digging into those financial statements.
So they're not afraid to get their hands dirty.
Not at all. They're looking for those hidden gems that the market might be overlooking.
Yeah, and what I really appreciate about Graham's approach is he doesn't present one as being better than the other.
Right.
He's saying, hey, there's different types of investors, and you need to figure out, what works best for you.
Exactly. What are your strengths? What are your interests?
Right.
What kind of time do you have?
Yeah, how much time do you want to spend on this?
Exactly.
Yeah. So for our listener out there, think about, where do you fall on that spectrum?
Yeah.
Are you more the kind of person who just wants to kind of set it and forget it? Or are you really interested in, digging in?
Right.
And becoming more of an active investor?
And there's no right or wrong answer.
Exactly.
It's just about finding what suits you.
Yeah. So now, regardless of which approach we choose, Graham really emphasizes that stocks aren't just these abstract, tickers on a screen.
Right.
They actually represent ownership in real businesses.
Absolutely.
So how does that shape his approach to analyzing, potential investments?
It's really central to his whole philosophy. So
Yeah.
he stresses the importance of understanding the businesses you invest in, not just looking at, market trends or charts or, trying to time the market.
Right.
You really got to understand what the company does.
So go beyond just the, kind of the hype and the headlines.
Exactly.
Look at the nuts and bolts.
And look at, how does the business actually make money?
Exactly.
Yep.
So he talks about, looking at the balance sheet, the income statement, the cash flow statement.
And for somebody who's not a financial expert, those can be pretty intimidating to look at.
Right.
So what are some of the key things we should be looking for?
Well, one of the things that Graham talks about is networking capital.
Okay.
So that's essentially the difference between a company's current assets and its current liabilities.
So it's basically a measure of, how much cash the company has on hand.
Yeah. Can they pay their bills?
Can they pay their bills? Yeah.
Exactly. So a healthy net working capital suggests that the company has some flexibility.
Right.
They can weather those unexpected storms.
So it's a sign of, short-term financial stability.
And I remember Graham was also a big proponent of focusing on companies with a history of stable earnings.
Absolutely.
Not just one good year, but, consistent earnings over time. Why was that so important to him?
So he believed that, consistent earnings demonstrate that a company can generate profits over time. They're not just a one-hit wonder.
Look, it's not a flash in the pan.
Exactly. And that ultimately translates to value for shareholders.
Okay, so they're reliably making money and hopefully sharing some of that profit with us as investors.
Exactly.
Now, how do we apply these concepts in today's market where we have all these, tech companies that have these, sky-high valuations.
Yeah.
But maybe not a lot of tangible assets.
Yeah.
The old economy companies had factories and, equipment.
Yeah.
But a lot of these tech companies, it's more about intellectual property and, things that are harder to kind of quantify.
Right. That's a great question. And, it gets at the heart of how do we adapt Graham's principles for the modern market? And I think, he would probably caution against getting caught up in speculative frenzy, even when it comes to, really innovative companies.
So even if a company seems like it's, the next big thing,
right,
we still need to look at the financials with a critical eye.
Absolutely. Look at things like debt levels, cash flow, their ability to actually generate earnings.
Right.
Because a lot of these valuations are based on, projections of future growth.
Right. It's all about the future.
Right.
But as we know, the future is uncertain.
Exactly. And, you can't just bank on that.
Right.
You got to look at what are they doing today.
Yeah. What's the track record?
Exactly.
So let's say we've done our homework. We found a company we looks promising based on Graham's principles. How do we actually determine the right price to pay for it?
Right. So that's where this idea of intrinsic value comes in. Yeah. And intrinsic value, as Graham defines it, is the true worth of a business.
Okay.
Based on its assets, its earnings, and its future prospects.
So it's not the same as the market price.
It's not the same as the market price, exactly.
Which can be all over the place.
All over the place, yeah. Driven by, all sorts of emotions and speculation.
Right.
So we have to come up with our own estimate of
Okay.
what that intrinsic value is.
And then look for opportunities to buy it when the market price is lower.
Exactly. That's the essence of value investing.
Yeah.
You're trying to find those bargains.
Finding a good deal.
Finding a good deal.
Yeah. So did Graham actually provide any, methods for calculating this intrinsic value?
He did. So he recognizes that it's not an exact science.
Right.
But he gives a number of methods.
Okay.
So one of the things he talks about is discounted cash flow analysis.
Okay, so we're getting a little bit technical here, but basically that's looking at, the future cash flows of a business.
Right. You're estimating how much cash they're going to generate.
Right. And then we have to kind of, adjust that for inflation and risk.
Exactly. You bring it back to today's dollars.
Yeah.
And that gives you a sense of what that future stream of cash flows is worth today.
Okay. And he also talked about, things like book value.
Wow. Yeah. So book value is essentially the net worth of a company's assets.
Right.
So what are those assets actually worth?
Yeah.
If you were to liquidate the company,
okay,
what would you get for them?
Interesting. And earnings yield.
Yeah. So earnings yield is another way to look at it.
Okay.
And that's comparing a company's earnings to its market price.
So are they actually generating enough earnings to justify their current price?
Exactly. Are you getting a good return
Yeah.
on your investment?
So it sounds like a pretty comprehensive approach.
Right.
We're taking into account, their current financial position, but also, their growth prospects.
Right. You're trying to look at both the present and the future.
But even with all this analysis, there's still an element of uncertainty.
Absolutely.
We can't predict the future.
No one has a crystal ball.
So how do we deal with that?
That's why that margin of safety is so crucial.
Right.
You're essentially building in a buffer
Okay.
to protect yourself.
So if we're wrong, it's not a disaster.
Exactly. And remember, Graham was writing this
Right.
in the aftermath of the Great Depression
Yeah.
and World War II.
Right. So he had seen a lot of market turmoil.
He had seen a lot of turmoil, and he understood the importance of protecting capital
Yeah.
during times of uncertainty.
And which we definitely have today.
Absolutely.
Things are very volatile.
Right.
So those insights are more relevant than ever.
I think so.
Now, I know Graham also delved into more specialized topics like, analyzing bonds and preferred stocks.
Right.
What was his approach to those kinds of investments?
So when it came to bonds, he really emphasized the importance of creditworthiness.
Okay, so making sure that the borrower is actually going to pay you back.
Exactly. And also looking at interest rate risk.
Right, because as interest rates go up, bond prices tend to go down.
Exactly. So he advised investors to focus on high-quality bonds issued by, financially sound companies or government.
So even with bonds, which are considered to be relatively safe investments,
Right.
he was still saying, hey, you got to do your homework.
Absolutely. You can't just assume that any bond is a good investment.
Right.
You got to look at who's issuing it.
Yeah.
What are the terms?
Okay, and what about preferred stocks?
So with preferred stocks, he was particularly interested in those that offered a high dividend yield
Okay.
and a strong track record of dividend payments.
So he was looking for companies that were, consistently paying out a portion of their profits to shareholders.
Exactly. And he saw that as a potential source of both income
Okay.
and capital appreciation.
So you could potentially benefit from both the dividends and the stock price going up.
Exactly.
Interesting. So it seems like he applied those same principles of value investing
Right.
to all types of securities.
Absolutely. Thorough analysis,
Yeah.
a focus on intrinsic value,
Right.
a margin of safety. Those are his core principles.
Regardless of what you're investing in. Now, we've talked a lot about the analytical side of investing,
Right.
but Graham also dedicated a significant portion of his book to the psychology of investing.
Yeah.
Why did he think that was so important?
So he understood that our emotions can often lead us to make irrational decisions.
Yeah.
Especially when it comes to money.
Right. Fear and greed can be very powerful.
Absolutely. And he actually introduced this concept of Mr. Market.
Okay, Mr. Market, I've heard that term before.
Yeah. So imagine Mr. Market as this emotional
Okay.
and often irrational business partner
Right.
who shows up at your door every day,
Okay.
offering to buy or sell you stocks
Okay.
at a certain price.
Okay, so every day the market is giving us a different price.
Every day you've got a new offer.
Okay.
But the problem is that Mr. Market is very moody.
Okay.
Sometimes his prices are reasonable,
Right, yeah.
but often they're driven by, fear, greed, or just plain whimsy.
So he's representing the market as a whole.
Right. He's kind of this personification of the
Right.
market.
Okay, and how it can be so unpredictable.
Exactly. And Graham's point is that the intelligent investor doesn't have to play Mr. Market's game.
Right.
You don't have to react
Yeah.
to every offer that comes your way.
So we don't have to buy or sell just because the market's telling us to.
Exactly.
We can make our own decisions.
Right.
Based on our own analysis.
Based on your own assessment of what that intrinsic value is.
Right.
So you can choose to ignore Mr. Market
Yeah.
when he's being unreasonable.
And just wait for a better opportunity.
Exactly.
Okay, so it's about having the discipline to kind of stick to our principles
Absolutely.
and not get swept up in the emotion of the moment.
Right, because those short-term price fluctuations are inevitable.
Right. The market's always going to go up and down.
It's always going to go up and down.
Yeah. But in the long run, it tends to reflect the underlying value of businesses.
Right. So if you're focused on those fundamentals,
Yeah.
you don't have to worry so much about those day-to-day swings.
So even when things get really crazy,
Yeah.
the intelligent investor stays calm
Stays calm.
Yeah. and makes decisions based on, logic and reason,
Exactly.
not fear and greed.
Right.
And that's really hard to do.
It is. It takes practice.
Yeah.
But that's what separates the successful investors from the unsuccessful ones.
Now, I know Graham also advocated for a strategy called dollar cost averaging.
Right.
Can you explain what that is and how it fits into his overall philosophy?
Absolutely. So dollar cost averaging is this really simple
Okay.
but effective technique
Okay.
for managing risk and taking advantage of market fluctuations.
Okay.
So it involves investing a fired amount of money
Okay.
at regular intervals.
Okay, so maybe every month or every paycheck.
Exactly. Every month, every paycheck, whatever works for you,
Okay.
regardless of the current market price.
So you're not trying to time the market. You're just saying, hey,
Yeah.
I'm going to put in, X dollars every month.
Exactly.
No matter what.
No matter what.
Okay.
And the beauty of that is that you're buying more shares
Right.
when prices are low
Right.
and fewer shares when prices are high.
Mm-hmm. So it kind of averages out your cost.
It averages out your cost over time. Exactly.
Okay. And it also takes the emotion out of it.
It takes the emotion out of it. You're not trying to guess
Right.
when is the best time to buy.
You're just systematically investing.
Systematically investing, exactly.
And letting the market kind of do its thing.
Right.
And that's something that, especially for somebody just starting out,
Yeah.
could be a really good approach.
Absolutely.
They can just dollar cost average into a, diversified portfolio of index funds.
Right.
And not have to worry too much about, picking individual stocks or timing the market.
Exactly. It aligns really well with Graham's principles of minimizing risk
Right.
and taking a long-term perspective.
Right.
You're not trying to get rich quick.
Yeah.
You're trying to build wealth.
Slowly and steadily.
Slowly and steadily, exactly.
Now, throughout the book, Graham provides some really fascinating case studies
Yeah.
of companies that either thrived or failed,
Yeah.
kind of illustrating these principles in action.
Right.
So can you share one of those examples?
Sure. So one of the examples that he talks about is American Machine and Foundry.
Okay.
And this was back in the 1960s.
Okay.
And this was a conglomerate
Okay.
that was involved in a wide range of businesses, from bowling equipment to aerospace technology.
So all over the map.
All over the map.
Okay.
And Graham was intrigued by the company
Okay.
because it had a strong financial position, history of consistent earnings.
Right. Those things we were talking about.
Exactly.
Yeah.
And it seemed to have potential for growth
Right.
in these emerging industries. But he also cautioned against the complexity
Yeah.
of analyzing a conglomerate.
Okay, because they're doing so many different things.
Right. How do you really assess the value
Right.
of each of those individual businesses?
It's hard to get a clear picture.
It's really hard to get a clear picture.
So even though the company looked good on the surface,
Right.
there were some underlying risks.
There were some underlying risks, exactly.
Yeah. And did those risks eventually materialize?
So as it turned out, American Machine and Foundry
Okay.
did eventually face some challenges
Okay.
as some of its businesses struggled to keep up
Right.
with changing market conditions.
So it wasn't a complete disaster,
Right.
but it wasn't, the home run.
It wasn't the home run that some people had hoped for.
Yeah. So what's the lesson there?
So I think the lesson there is that, even when a company appears to be a solid investment,
Yeah.
it's important to really dig deeper,
Right.
understand those operations
Yeah.
and potential risks.
Especially when it comes to these. Yeah. So can you give me an example of, how he kind of goes against the grain?
Sure. So one of his most contrarian ideas is his argument for why investors should focus on finding undervalued companies
Okay.
rather than trying to predict which companies will grow the fastest.
Okay. So that's kind of counterintuitive, because wouldn't it be more profitable to invest in the companies that are going to grow the most?
That's what a lot of people think.
Yeah.
But Graham's point is that even if you can accurately identify a high-growth company,
Right.
if the market already recognizes that potential, you've already missed out on a lot of the profit.
Because the price is already reflecting that growth.
Exactly. The price has already been bid up.
Yeah.
So you're not going to get as much of a return
Right.
as if you had found that company
When it was still undervalued.
exactly when it was still under the radar.
So it's all about finding those hidden gems.
That's where the real opportunities are.
Yeah.
Those companies that the market hasn't fully appreciated yet.
Okay, so we're not chasing the hot stocks. We're
Right.
looking for the ones that are kind of, overlooked.
Exactly. And that's the essence of value investing.
Right.
You're trying to find that discrepancy
Yeah.
between the price
And the value.
and the value, exactly.
Now, we've covered a lot of ground in this deep dive.
Mhm.
We talked about temperament. We talked about financial statements.
Right.
The emotional ups and downs of the market.
Right.
What are some of the key takeaways
Yeah.
that you would want our listener to remember, as they kind of embark on their own journey?
Yeah, so I think one of the most important takeaways is that Investing is a marathon, not a sprint.
Yeah.
So don't get discouraged
Right.
by those short-term market fluctuations.
It's easy to kind of get caught up in the day-to-day noise.
It's very easy. And, don't try to chase the latest hot stock tip.
Right.
Instead, focus on building a portfolio of solid companies
Right.
that you understand and believe in.
Right. And be patient.
Exactly.
Let those investments grow over time.
Yeah.
And it's easy to forget that.
It is. And, Graham really stresses the importance of temperament
Yeah.
and discipline.
Because it's so easy to get emotional about money.
It really is.
Especially when you see those big swings in the market.
Exactly.
Yeah.
Fear and greed can really take over.
Right.
And lead us to make decisions that we later regret.
So what are some things that we can do to kind of mitigate those emotional biases?
So one of the most effective strategies, I think, is to have a clear investment plan
Okay.
and stick to it.
Okay, so write it down.
Write it down, exactly. Outline your investment goals.
Yeah.
Your risk tolerance.
Right. How much risk am I comfortable taking?
Exactly.
Yeah.
And your asset allocation strategy.
So how am I going to divide my money?
Exactly. How much am I going to put in stocks?
Yeah.
How much in bonds?
Right. Do I want to invest in real estate?
Exactly.
What's the right mix for me?
Exactly.
Okay. And then once you have that plan, you stick to it.
You stick to it even when the market gets turbulent.
Even when you're feeling scared.
Even when you're feeling scared or greedy.
Right.
You go back to that plan.
And it kind of keeps you grounded.
It keeps you grounded.
Yeah.
And it prevents you from making those emotional decisions.
That we're going to regret later.
Exactly.
Yeah. And diversification is key.
Diversification is absolutely key.
You don't put all your eggs in one basket.
Don't put all your eggs in one basket. Exactly.
Spread your money around.
Spread your money around.
Different asset classes, different industries.
Different geographies.
Different countries.
Exactly. Because you never know what's going to happen.
What's going to happen exactly.
So as we wrap up this deep dive into the intelligent investor, what are some final thoughts that you'd like to leave our listener with?
So I think the most important message from Graham is that anyone can become an intelligent investor.
Okay.
It's not about having a high IQ or access to insider information.
Yeah.
It's about developing the right mindset.
The discipline to do your research.
Right.
The patience to stick to your principles.
It's a journey.
It's a journey.
It's not a destination.
Exactly. And it's a process of continuous learning.
Yeah. And it's important to remember that investing is not a get-rich-quick scheme.
Right.
It's a long-term game.
It's a long-term game. Exactly.
Yeah. So, we have to be prepared for the ups and downs.
Right. And, Graham's wisdom has really stood the test of time.
It really has.
And I think his insights can help investors of all levels achieve their financial goals.
Yeah. I think this deep dive has been a fantastic exploration of his principles.
I agree.
And, we've only just scratched the surface.
Absolutely.
There's so much more in the book.
Yeah.
So I encourage you to, go out and read it.
Right.
And, really dig into it.
Yeah. And if you're ever feeling tempted to overcomplicate your investment strategy, just think back to that pizza analogy.
Right. Slicing things up differently doesn't magically create more value.
Oh, exactly.
Focus on the substance, not the sizzle.
Exactly.
Thanks for joining us.
Thanks for having me.
That pizza analogy is so good.
Yeah.
It really drives home the point that, complexity doesn't always equal effectiveness.
Exactly.
And, it seems like Graham was pushing back against, all these fancy schemes.
Absolutely.
And, people trying to outsmart the market.
Yeah, he was very skeptical of what he called, clever or fashionable investment strategies.
Right.
And I think, he believed that a lot of those approaches were more about generating fees for Wall Street than actually creating value for investors.
So instead of trying to time the market or pick the next hot stock, he was advocating for this more grounded approach.
Absolutely.
Focusing on intrinsic value, building that margin of safety.
Exactly.
And, just kind of sticking to those principles.
Oh. Right. And I think he believed that, a well-informed, patient investor could actually outperform the market over the long term.
By just being disciplined.
By just being disciplined. Exactly.
Which is hard.
It is hard.
Especially in today's environment where, we're constantly being bombarded with information.
With information, with advice.
Yeah.
It's easy to feel like we need to be constantly trading
Yeah.
or adjusting our portfolios.
Yeah. It's like FOMO, fear of missing out.
Exactly. And Graham would say,
Yeah.
that's all counterproductive. True investing is about, carefully selecting high quality assets and then holding on to them for the long haul.
Yeah. Let compounding work its magic.
Exactly. That's how you build wealth.
That makes me think of that quote where he said, the investor's chief problem and even his worst enemy is likely to be himself.
It's so true.
It's not about, outsmarting the market. It's really about mastering our own emotions.
Exactly.
And our own impulses.
And, he really understood that, fear and greed can really drive us to make some really bad decisions.
Yeah.
That we ultimately regret.
So what are some practical steps that we can take, to kind of mitigate those emotional biases?
Right. So one of the most effective strategies, I think, is to have a clear investment plan.
Yeah.
And stick to it.
So write it down.
Write it down exactly. Outline your investment goals, your risk tolerance.
How much risk am I comfortable taking?
Exactly.
Yeah.
And your asset allocation strategy.
How am I going to divide up my money?
How are you going to divide up your money? Exactly.
Like spawns real estate.
Exactly. And once you have that plan, you stick to it.
You stick to it no matter what.
Even when the market's going crazy.
Even when you're feeling scared.
Even when you're feeling scared or greedy.
Yeah, you don't abandon the plan.
You don't abandon the plan.
You stick to it.
You stick to it.
Okay.
And it keeps you grounded.
Yeah.
And it prevents you from making those, really emotional decisions.
That we're going to regret later.
Exactly.
Yeah.
And then, of course, diversification is key.
Right. Spread your money around.
Spread it around.
Different asset classes.
Different
industries, different geographies.
Yeah, because you never know what's going to happen.
You never know what's going to happen.
So as we wrap up this deep dive, into the intelligent investor.
Yeah.
What are some final thoughts you want to leave our listeners with?
So I think, the most important message from Graham is that anyone can become an intelligent investor.
Yeah.
It's not about having a high IQ.
Right.
It's not about, having access to some special information.
Right.
It's about developing the right mindset.
Okay.
The discipline to do your research.
Yeah.
And the patience to stick to your principles.
Yeah, I love that.
It's so empowering.
It is empowering.
Because it's saying, hey, you don't have to be a Wall Street genius to be a successful investor.
Right.
You can do this.
You can do this.
Yeah.
And it's a journey.
Yeah.
It's a process.
It's not a destination.
It's not a destination, exactly.
And, it's a process of continuous learning.
Absolutely.
And it's important to remember that investing is not a get-rich-quick scheme.
Right.
It's a long-term...
It's a long-term game.
Yeah.
It's about building wealth.
Yeah.
Slowly and steadily.
Yeah. And being prepared for those ups and downs.
Absolutely.
Because they're going to happen.
They're going to happen.
Yeah, but, Graham's wisdom has really stood the test of time.
It really has.
And I think his insights can help investors of all levels
absolutely
achieve their financial goals.
Yeah.
I think this has been a fantastic exploration of his principles.
I agree.
And we've really only scratched the surface here.
Absolutely.
There's so much more in the book.
Too much more.
So I encourage everyone to go out and read it.
Yeah.
And, if you're ever feeling tempted to overcomplicate your investment strategy.
Right.
Just think back to that pizza analogy.
Exactly. Slicing things up differently.
Doesn't magically create more value.
Doesn't magically create more value.
Focus on the substance, not the sizzle.
Exactly.
Thanks for joining us for this deep dive.
Thanks for having me.
It's been a pleasure.